What's up everybody, Gen X Dividend Investor here. So SCHD's dividend payout came in lower this quarter compared to last year, and that's freaking some people out. But that doesn't tell the whole story, so stay tuned as I break things down for you. Then I'll end this episode by responding to a commenter who seemed to feel like dividends are just for wealthy folks. And I'll share 2 quick investing things my wife and son did this week that made me smile. Okay, so the original catalyst for this video came from a bunch of comments I was seeing about SCHD. Some were alarmist, some were frustrated, and some were genuinely curious. Like one of the curious ones came from a nice subscriber of mine named Lister Bliss, who said, quote, hopefully you do a video at some point to update us on your current thoughts on SCHD and its recent dividend cut, because I remember you mentioning that a dividend cut is a major reason you'd consider dropping a stock from your portfolio, end quote. And for those who aren't familiar, SCHD, aka the Schwab US Dividend Equity ETF, is a dividend ticker I'm long in. It's a low-cost fund that holds about 100 high-quality US companies with strong records of paying and growing dividends. It pays quarterly and is designed for investors looking for a mix of income, stability, and long-term growth. The fund uses an algorithm to pick its stocks, and here are the current top 10 positions. Companies you'd recognize like Texas Instruments, Chevron, AbbVie, Home Depot, and a few others. SCHD launched in 2011, and since then it's paid out more in dividends per share every single year. Take a look at SCHD's dividend history on Seeking Alpha over the last 5 years. That'll help illustrate why some people are freaking out right now. So you can see that SCHD's most recent quarterly payout in 2025 was about 26 cents per share. Before that it was 24.88 cents, and then before that, in Q4 of 2024, it was 26.45 cents. Seeing some quarterly payout volatility like that is pretty normal for dividend ETFs, since they often change the stocks they hold as time goes on. Now if you go one more quarter back to Q3 of 2024, you'll see a much larger payout of 75.45 cents per share. At first glance it might look like there's a dividend cut somewhere in there, but there actually wasn't. What happened was that SCHD did a 3-for-1 split. So if you held 10 shares before the split, you'd now have 30 shares after. And your overall payout would have stayed the same because the per share dividend got reduced by a third to adjust for the split. That's why the 75-cent payout looks about 3 times higher than the next one, which ended up being around 26 cents. But that's not what's really freaking people out right now. No, the angst is coming from the fact that the most recent payout of 26 cents is lower than what it was the same time last year. Back then it was 27.47 cents per share adjusted for the split. That's why some folks are calling it a dividend cut, because the year-over-year payout for the same quarter went down. But the truth is, that's not officially a dividend cut. At least not yet. You've got to look at the total dividends paid out per year, not just per quarter, especially when you're dealing with ETFs. Their payouts bounce around way more than individual stocks do. That's actually one of the reasons I prefer good individual dividend stocks, even though they come out with their own set of risks. Check out this graph of SCHD's dividend history over the last 5 years. It gives you a clear picture of how things moved around. The important part is that they've been trending up over time, even though quarter over quarter can be volatile. And if you're looking at the graph, that S marker is when their 3-for-1 split happened. Okay, let's compare SCHD's dividend chart to another ticker I'm long in, Procter & Gamble. They've raised their dividend every single year for multiple decades. Here things look a lot smoother, like you'd expect from a company that's been hiking its dividend like clockwork. I mean, basically you see 4 quarters of the same payout, then a hike, 4 quarters of the same payout, then a hike, and so on. And if you understand how SCHD's stock selection algorithm works, then you wouldn't be surprised by what the data is showing. Remember, it's made up of around 100 tickers. Every quarter, SCHD's managers use its algorithm to adjust the weightings of the holdings to match the target allocation set by the Dow Jones US Dividend 100 index that it follows. So that means they buy and sell various tickers to get the portfolio back to the desired allocation. And doing that changes the overall payout, which is why things bounce around so much. Beyond that, we also know that every year, typically in March, the fund's underlying index gets refreshed. Basically, it selects the top 100 stocks from the thousands of US dividend payers out there based on criteria like having 10 years of consistent dividends, decent dividend yield, strong cash flow, good return on equity, decent dividend growth, and stuff like that. This means some stocks get removed from SCHD and others get added, which also contributes to the fluctuations in payouts. For example, I read that in March of 2025, about 20% of SCHD's holdings were replaced. So basically, SCHD updates how much of each stock it holds every quarter, and then updates which stocks it actually holds once a year, all based on what the algorithm decides are the best fits. Because of that, I don't see the latest payout as a dividend cut. I understand how the algorithm works and that these things will shift over time. Now, we could still end up at year-end with what might technically count as a dividend cut, but it's too early right now to know how the year will play out. Each ETF has its own strengths and weaknesses, and I always encourage people to really understand how an ETF works before they invest. That way you can kind of predict what might happen. With that being said, I'm pretty confident that SCHD will not go up every single year, nor will any dividend ETF. But I'm also confident that SCHD will trend up over time. Or to say that differently, I expect there will be years where SCHD doesn't pay out more than the year before. And yes, that'll technically be a cut. If you can't stomach that possibility, you probably shouldn't be investing. But that's kind of what you get when you choose a dividend ETF instead of an individual stock. Of course, nothing is going to go up forever, and you'll probably see more fluctuations with ETFs. So even great individual dividend stocks will eventually stop hiking or cut their dividend. It might not be while you're alive, but someday it'll happen. I mean, 3M was a dividend darling until it wasn't. Same thing with Leggett & Platt or AT&T, or going back a bit, GE. Part of the reason people go with ETFs is to minimize the risk that comes with individual stocks. With a stock, a cut or suspension can really nail your income. But with an ETF, you're more likely to see a dip than a wipeout, and ideally you're investing for the overall trend. So if SCHD did end up paying a lower dividend one year than the previous one, I probably wouldn't sell it. I'm in SCHD for the long-term trends, not for quarter-over-quarter or even year-over-year fluctuations. I'd probably sell it if they changed the algorithm and I didn't like what it became, or for a variety of other reasons, but right now I have no plans to sell. In fact, it's one of the few tickers I'm still slowly adding to, using a portion of its own quarterly payout. I find it to be a solid balance between dividend yield, dividend growth, and quality companies. So to respond to Lister Bliss, I'd say I don't view what happened as a dividend cut, and I plan to keep on holding. If it were an individual stock and they cut their dividend, then yeah, I'd probably sell. That doesn't mean you should or shouldn't do the same. I'm just sharing how I personally see it. Now, a different concern some people have is that SCHD stock price has kind of languished lately. For example, if you look at the 10-year total return of SCHD compared to VTI, which tracks all US public stocks, and VU, which tracks the 500 largest US stocks, here's what you'll see. SCHD returned 191%, VTI returned 231%, VU returned 250%. So SCHD had good returns, but not market-beating returns, which is honestly what I'd expect in a strong bull market. I'd also guess that SCHD would probably hold up better if we go sideways or down for an extended stretch. I say probably because I'm making an educated guess based on how the fund is built, and I've been around long enough to know that no one can consistently predict what the market's going to do. That being said, SCHD has a solid long-term case for risk-adjusted performance, especially in low-growth, inflationary, or choppy markets, and it'll probably underperform during high-growth, tech-driven bull runs. But it could also surprise me and do better than I expect. I mean, dividend stocks have outperformed non-dividend stocks on average over long periods of time across global markets. For example, Jeremy Siegel, a prominent finance professor and author of Stocks for the Long Run, has extensively studied the long-term outperformance of dividend stocks and their role in total returns. He emphasizes that dividends are a tangible form of return and can provide more stability during market downturns. His research consistently shows that dividend-paying stocks tend to deliver stronger risk-adjusted returns over decades. And then a 2011 study by Fuller and Goldstein found that dividend-paying stocks outperform non-dividend-paying stocks by 1 to 2% more per month in declining markets than in advancing markets. That helps support the idea that dividend stocks provide some downside protection. Hartford Funds concluded that companies that grew or initiated a dividend have seen the highest returns relative to other stocks since 1973 and with significantly less volatility. Now, will that continue? Well, I think AI is going to be a major jolt for a lot of companies, both in positive and negative ways. Over the long term, I imagine US markets will eventually slow down, and I think I'll be well positioned for that kind of environment. Barron's recently mentioned that during slow growth, neutral inflation periods, dividend growers returned around 6.2% annually, while non-payers actually lost more than 10%. Bottom line, dividend-paying companies are usually more established and less sensitive to sudden economic shifts, so they tend to offer more stable returns in those kinds of periods. But non-dividend stocks can still have explosive returns like Amazon. So unless you really want passive dividend income, I wouldn't ignore non-divvy growth tickers altogether. That being said, I think SCHD is one of the better dividend ETFs out there for folks who want decent companies, a decent yield, some growth potential, and a focus on passive income. If your goal is total returns, then it'll probably be hard to beat something like VTI or VU over the long run. And some investors find value in holding both SCHD and a market index. They might use SCHD for dividend income and stability, and then something like a broad market index fund for overall market exposure and growth potential. And before anyone leaves me a comment about some ultra-high yield ticker that's outperformed for the last 5 years or whatever, my response would be that's great, but I'm confident that won't hold up over the next few decades. Anyway, about 6.5% of my portfolio is in SCHD, and like I said, I currently reinvest about 20% of its quarterly drip back into itself. I plan to keep buying more of it using its own payouts for the rest of my life because I like how its algorithm works and the company behind it. I'm confident that 50 years from now, SCHD will be holding a bunch of different stocks, and that's part of what makes it great to me. I mean, my portfolio will only change if I sell a ticker or buy a new one. But think about how hard and risky that strategy is when you're trying to build true generational wealth. Lots of companies can go bankrupt or just stop existing for all sorts of reasons. Think of Enron, Lehman Brothers, Blockbuster, Sears, Radio Shack, and plenty more that also stopped paying dividends along the way. That's why I think dividend ETFs are a more sustainable, long-term income-generating asset compared to individual dividend stocks. Dividend ETFs will probably keep evolving over time, but individual tickers need your active management. I sometimes get asked why I don't just go all in on dividend ETFs, given everything I've said. Like this week I got a question from a subscriber named jplays568 who said, if you were starting over, would you invest in dividend ETFs rather than individual stocks that pay a dividend? Did you ever consider moving your current portfolio into one or more dividend ETFs like SCHD or DGRO just to diversify and or simplify things? Well, if I were starting over, I'd probably still build a portfolio that includes both individual stocks and ETFs. I've done well investing in individual stocks, and honestly I just really enjoy owning specific companies. There's something more engaging about following a business, understanding what makes it tick, and watching it succeed. That kind of connection is harder to get with an ETF. Another reason I like individual stocks is the flexibility. I can focus on companies or sectors I believe in more strongly and sometimes find better value, higher yield, stronger CAGR, or more exposure to industries I like, or whatever. That being said, funds like SCHD and DGRO are great tools for diversification and simplicity. They give you instant exposure to a broad group of high-quality dividend-paying companies, which helps reduce risk and makes returns more consistent. I also appreciate that they require less maintenance. You don't have to track earnings reports or manage rebalancing yourself. SCHD is actually one of my largest positions because of all that. But at the same time, I enjoy the control and customization that comes with building part of the portfolio myself. With individual stocks, I can lean into areas I believe in, sometimes find opportunities that feel under the radar or undervalued. So in the end, I prefer a mix. I like the diversification, consistency, and simplicity that ETFs offer. But I also enjoy the hands-on approach, the flexibility, and the personal connection that comes with owning individual stocks. Not to mention the opportunity to seek some alpha. So would I recommend young people go into SCHD? Well, that depends. If you need income now, then I think SCHD is worth considering. But if you're more focused on growing your portfolio and don't need income, which is often true for younger people, then I'd probably look elsewhere. I definitely recommend it for people in retirement who want a solid income stream that has a good chance to grow over time, probably faster than inflation. That reminds me of a relative I have who's older and starting to become more forgetful, and should be a great candidate for a dividend ETF like SCHD instead of some other asset type. It really depends on your needs, your goals, and your risk tolerance. Now, a common mistake a lot of people make is buying something, holding while it takes a beating, and then selling in frustration right before it turns around. Or maybe they wait and the FOMO gets to them and they end up buying near the top just before things pull back. The market is way too tough to predict accurately, but I do think the next real pullback could be pretty interesting. We've got a ton of people out there who've never experienced a recession or a dip that lasted for years. Yeah, we had the pandemic blip, but I'm talking about what we saw between 2000 and 2013. Will people still buy the dip if we stay down for years? I don't know, but I know that investor psychology feels completely different when things look rough for years instead of months. But who knows, I could also see this AI era continuing, where companies become more efficient, more profitable, and stocks keep climbing. The good news is, my investment strategy doesn't need to change whether the market goes up, down, or sideways. Leave me a comment and tell me if you feel confident about how you're investing. Moving on, an interesting comment I got this week was from someone who said, instead of paying dividends to rich fat cats, why don't they use the money to pay their employees a living wage? So I've got a few thoughts on what they said. First off, dividends are not just for the wealthy. Anyone can invest and earn them, even with small amounts through index funds or individual stocks. Dividends can give regular people a way to build passive income and share in a company's success. At the same time, I completely agree that employees deserve fair pay. But rewarding shareholders and treating workers well don't have to be mutually exclusive. A strong, sustainable business should aim to do both. Now, I say all this without really knowing the full context of that comment. Like, were they just venting about low wages? Or did they fully understand how dividends work and were just emphasizing labor over capital? I often have to make assumptions when I respond to comments, and I've definitely gotten things wrong before. The reality is, there's a wide range of investing experience among people who watch these videos. For example, I've had 2 people tell me that during their first couple of years investing, they would just transfer money into their brokerage account without actually buying anything. They didn't realize you had to place a trade to actually own stock. So yeah, there's a wide swath of people who watch videos like mine. And so when I respond to comments, I'm making my best guess about where someone's coming from. It's social media where one-line comments can be easy to misread or understand. So I just want to say I'm sorry if I ever misunderstand or respond without fully getting someone's point. I try to respond to every comment I see, and that means I often end up replying quickly just to get through the ever-growing pile of messages from email, Instagram, Twitter, Discord, and everything else. Anyway, to close things out, I wanted to share a couple of quick exchanges I had this week with my family that really made me happy. The first one happened when my son gave me $40 in cash that he earned from helping a close relative with yard work over a couple of days. He told me his long-term plan is to always invest 50% of any money he makes, but right now he's investing pretty much all of it. Normally when he gives me cash to invest, I just stick it in my wallet and then transfer double that amount into his custodial account as a way to reward him for being smart with his money. And then we both invest it. And then yesterday I had another cool moment, this time with my wife. She told me she wants to open a taxable account and start putting in $20 a week from her hourly job. It's a job she really enjoys and she works less than 40 a week. I've tried to get her to quit, but she loves getting to chit-chat with coworkers and clients. Anyway, her wanting to invest is actually a pretty big shift for her because while she's always appreciated that I've built up a solid portfolio, she's never really been into investing herself. She's still asking me to set it up and manage it for her, so she's not quite ready to handle everything on her own. But hey, baby steps. And with that, I ask you to take baby steps on my behalf and hit that thumbs up button, subscribe if you haven't yet, and click the bell notification. Now I'd like to show my gratitude to subscribers who've left me really nice comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Dara Stewart 8478, Feld HDLEH, Quanti JS, Jake Chisel 007, Lee Pickle, Tracking Arette, Helen Brooks 2273, Busta Brick, and I am Bry Guy 4. Thanks folks, I really appreciate it. Now I'd like to recommend that people check out my Seeking Alpha affiliate link, which has a discount when new users sign up. Next, I'll pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.